In the constantly changing world of fundability, the big question is this: how are entrepreneurs and real estate investors like us, ones who want to grow our businesses and who are tired of paying for really expensive alternative lending, how do we tap into the most inexpensive money available and do it without the hassle of typical borrowing? That is the question, and this podcast will give you the answers. Welcome to the Get Fundable podcast with your host, Merrill Chandler.
Welcome back, everybody. This is the Get Fundable podcast. And in this episode, all things HELOCs, home equity lines of credit. And I promise you, it is unlikely you've had this much detail about how to use, acquire, leverage, and profit using a HELOC. So when we come back, we're going to get down and dirty with what is, to me, the most sublime credit line available to homeowners and how to get one for yourself and how to use it. We'll be right back. So I promised you HELOC madness. We're going to talk mad, awesome talk about HELOCs. What's a HELOC? A HELOC is a home equity line of credit. And as the title, the moniker says, it is a credit instrument that is given, that is usually given by mortgage brokers and loan officers and mortgage brokers to cover or give access to the equity that is in your home. For right now, we're going to be talking about residences, right? Because lenders right now, typically your big lenders don't lend do HELOCs on secondary or investment properties. So a HELOC is your home, your residence, a home equity line of credit. Now, they are an amazing instrument. Now, if you've been to my boot camp, you know that I talk about business lines of credit all the time. The only credit instrument that beats, in my estimation, beats a business line of credit for versatility, the least expensive money available, and the most opportunities is a HELOC, a home equity line of credit. So let's do a deep dive. And for those of you who are studying the best way to use this HELOC, take notes. Let's pay attention, because this home equity line of credit is a game changer for you. So first things first, as I said, it's a credit instrument that is used to against the equity in your home. For example, let's say you have a $100,000 home and you put 20, or you're buying a $100,000 home. You buy you put down 20%, so you put 20 grand down. So your mortgage, the installment loan against that, the home loan value is $80,000 in this example. That leaves $20,000 of equity because you put your skin in the game, right? You put your money into that deal. Well, lenders sometimes, at the very beginning of this doing this deal, they'll do what's called an 80-20, which means they'll do 80% on a first, and then they'll do a 20% HELOC, because you put the money down, so the equity already is in the home. So the lender will say, I will give you, it's almost like a secured credit card, right? Except on the equity of your home. You're backing that equity. You're backing a credit instrument, a HELOC, home equity line of credit, with the equity in your home. So you have an $80,000 first, and you have in this case, you would have a $20,000 credit limit on your with backstopped by the equity. All right. Now, as your home appreciates, you can keep whatever you're paying down. Let's say you've paid down, like you learn in the boot camp, right? You stay ahead of the payment curve and payment slope. And so let's say over the course of a few years, you pay the $80,000 to $70,000. So now you have more equity available. Also, let's say your payment or your equity grows, the home value grows to $110,000. Well, if we pay down 10,000 of that 80 to turn it to 70, and we then experience appreciation of another 10,000. So you have a $20,000 credit line, but you have 40,000 now in equity. So you can refinance the equity in your home and increase the amount of your equity line, this home equity line of credit. Now, why is this important? Why do we want to do this? First of all, appreciation is free money. And second of all, you're making payments, whether you're going to use the equity in an equity line or not, you're going to be making payments, which lowers the balance. So this spread between the value of your home and that first is a perfect opportunity to have a line of credit that's backstopped by the equity of your home. Now, think of this way. The value of a home equity line of credit, it is extremely inexpensive money, right? Many times they will do this credit line will allow you to use any amount and pay it off. Use it, pay it off. So let's say that we still have our original 20. You do a deal, you do a wholesale deal. If you're a real estate investor, you buy something over here, you do home improvements, whatever it is that you do. Let's say you use $5,000. You write a check or use the credit card, the plastic that comes with these credit lines. You use that and you spend $5,000. Well, you only have to make payments on the $5,000. That's the beauty. You're not taking out a loan in this case of $20,000. There's a credit line to use whatever amount you wish of that $20,000. So let's say you use 5. Now you can do one of two things. You can make most institutions, most banks and lenders allow you to make an interest-only payment. Many of them on their websites will say, here's a minimum payment, which creates a pay down to zero, or this payment over here is just to pay the interest that you're accruing. So depending on how you're using that money, if you're using it to pick up another property, if you're using it to create value where you're actually leveraging the money you're using from this credit line to build more money or create more money, then interest only, that's a phenomenal return on your money. Follow me? So these instruments are amazing. Now, as I said, these home equity lines of credit from traditional lenders and banks usually apply only to your residence. But what about if you have a commercial endeavors, right? What if you have a commercial bank, a commercial building? What if you have investment properties? Well, there are other commercial lenders that are not the big banks, et cetera. We can't call them private because they're public entities. Some of them backed by hedge funds, some of them by private investors. But there are groups out there that will lend on the equity of any property you have. Commercial properties, residential properties, and they come in two types. They have loans based on your equity. So let's say you have $1 million in properties, and let's be aggressive. Let's say you have $1 million in properties. It's 10 properties, and the value of each is $100,000. Let's say between your paying it down and appreciation, let's say that you have $500,000 worth of equity between all 10 of these properties. Well, these commercial outfits will lend on all, if it doesn't matter if it's your personal residence or if it is investment properties or commercial properties, they will lend on the equity that you have inside of that aggregate compilation of investment properties. These are absolutely awesome investment opportunities, because now you're not working with the commercial banks. The money's a little more expensive, but when I say a little more, some of these, if you're an experienced investor, they may well offer you at 1 point above what traditional banks, right? Tier 1 and tier 2 banks are lending on. They tend to lend based on the equity involved and your experience as an investor. The more experience you have, the more success you've had, the lower your costs and the better the terms. All right. So but I just want to show you that there's home equity lines of credit, but then there are pledge loans, blanket lines of credit that will use as to backstop the credit lines or the loans. Will use the equity in all your properties or investment properties. Technically, HELOCs, home equity lines of credit, only are on your personal residence. All right. Now, continue. As I said a moment ago, the funds are very versatile, but there are certain couple of rules that you need to follow. Okay. Because I've been saying, hey, you can use these funds for business purposes, even though it's on your residence, and even though the loan is on your personal credit profile, even if you've deeded it to a business, you need to be very careful about how you use these funds, right? So if you're using it, you do not, and this is, talk to your CPA, talk to your tax advisors, but generally speaking, you do not want to use your home equity line of credit, that credit line. You do not want to use it for both personal and for business purposes. You don't want to go on vacation using it, and then you don't want to go over there and rehab a house using it. Because the IRS is very specific about what it and the litigious nature of real estate holdings, etc. You don't want to pierce the corporate veil. So what you do is you lease or rent this credit line to your business. Now, for those of you into the boot camp, my most successful clients tend to lease their home equity line of credit to their QFE. If you don't know what a QFE is, go to the boot camp, getfundablepbootcamp.com. Just find out, because there are some amazing tools available, amazing strategies for you to be able to leverage your home equity line of credit. Now, the other thing that's important is that if you're going to use it for business, then you need to have a piece of paper in the notes in your corporate Bible, your corporate book. You need to have a lease agreement. Very simple, one pager. You can talk to your advisors about how to do this, but you simply say, I'm leasing this credit instrument to the business for the purpose of expanding that business. Having done that, you can now use that and have the business pay the interest payments, have all payments, use it for the business as you wish. But you can't then all of a sudden go use it for your family vacation. So you want to make sure you use it for personal or business. Now, I defer to your CPA or your tax advisors if they say, well, you can say this transaction is this $10,000 of my $20,000 HELOC is dedicated to this one transaction. But I will leave that to your other advisors to figure that out. To make it simple, all business or all personal. Okay. Now, those things are very important. That way, you don't pierce the corporate veil. That way, if somebody's trying to take advantage of you, sue you, or otherwise, and they're looking at bank records, and you see, you're just using this home equity line of credit for anything and everything, that's going to ultimately get in your way. That's going to harm you. And we do not want to do that. But again, I defer to your CPA or tax advisors for the specifics of that particular, those decisions. Now, here's what's really, really interesting. How do lender software and how does FICO evaluate a HELOC? Because it is a real estate backed credit instrument, right? And it's kind of messed up, but again, I refer you to getfundablebootcamp.com if you want to find out about how all these things work. Just so you know, in the bootcamp, we talk about credit instruments for revolving accounts. There are 16 different variations on your credit cards, charge cards, credit lines, etc. But what's not included by FICO and lender software in those 16, HELOCs are considered are treated like a real estate backed loan, like an installment loan. They're not treated like a credit line. So in the documentation we fill out on the credit line, on HELOCs, we don't include it in like your revolving accounts portfolio. It's even though it's a revolving account, and I want to show you right now what that looks like. Even the different credit bureaus register it differently on your credit report. So let's for those of you who are watching, take a look on the screen. If you want to see this, they're going to be in the show notes at getfundablepodcast.com. You'll be able to see it in the blog. You'll be able to see these. But notice at the top it says BECU. Okay. Well, down in the middle, that represents Boeing Employees Credit Union. So there's two listings. Equifax and Experian list it as a line of credit. That's a HELOC right there. A $50,000. What you're seeing is a $50,000 line of credit. But TransUnion counts it as a mortgage, as in an installment loan. So even the bureaus report it differently, but FICO, straight from FICO's development team in our Q&A with them, is that they treat all HELOCs, home equity lines of credit, as a real estate backed loan. So that means, as you'll learn in the boot camp, or as you remember from the boot camp, loans don't move the needle as much, because most loans, not all, but most loans are guaranteed in some fashion. Like a mortgage is guaranteed, is backed by your house. And if it's a Fannie or FHA or Freddie, it's actually backed by the federal government if it fails. Auto loans are backed by an automobile, right? And are secured by the automobile. Even your student loans are secured by the federal government to reimburse a lender if for some reason you are unable to pay. Now, there are some loans that are unsecured, like personal loans, etc. But so many of them have some sort of guarantee or security to them that FICO doesn't cause them to move the fundability needle, the score needle, as much as unsecured credit cards, charge cards, and personal credit lines. So we have to keep those separate. Unsecured revolving accounts, credit cards, etc., are huge risks, and high balances there move the needle, the fundability needle, a ton. Not so with installment loans. And in this case, from this presentation, not so with HELOCs. So HELOCs do not move the needle. So you can have a high balance on this revolving account and still not get huge downgrades if you have high utilization, downgrades in fundability and a lowering of your score. For example, if you have a $50,000, like in the example from this Boeing Employees Credit Union, if you have a $50,000 credit line and you charge it up to 95% on a HELOC, there's going to be a 10, maybe 15 point lowering of the score and not much lowering of your fundability because it's backed by an appreciating asset. But if you have a $50,000 credit card and you charge that up to 95%, your score and your fundability, your attractiveness to future lenders is going to plummet. See the difference? So that's one of the reasons why I love HELOCs for use in your business expansion, real estate endeavors, anything that you are using in your wealth strategies, because it doesn't move the needle. Even though it's on your personal profile, it doesn't move the funding needle very much. And so you're not going to get, by having a high balance there, it's not going to lower your score or your fundability very much. Now, this is very important for us to cover. One of the features of your and we need to understand this. We go into it again a great deal in the boot camp, but one of the things we need to learn here in this presentation is that when you are using a home equity line of credit, you want to speaking of charging it up and paying it down, if you use the same type of relationship building philosophies and implement our bootcamp strategies, if you implement the bootcamp strategies inside in the HELOC, it doesn't get you higher limits like it would on unsecured. Unsecured, we want automatic limit increases, correct? But every HELOC you have out there will not give automatic limit increases because you have to reapply because they need to reevaluate the value of the property, see how much equity you have based on an appraisal. Thank you. Based on an appraisal, and then raise your credit line. So one of the great things about unsecured business lines of credit and credit cards is you can get automatic limit increases. That is not the case with the HELOC. You have to go through an entire reevaluation of the value of the property, how much equity you have, etc. So there are certain things that we have to be careful of on HELOCs, but use of funds is not one of them. Now we get to use those funds in a powerful way. Now, one of the super powerful uses of a home equity line of credit, because it is such a low cost credit instrument, that there are, like my dear friend and a brother from another, George Antone of finance.com, he teaches the master sweep account and encourages the use of the lowest, because it works best when you use as your master sweep account the lowest cost credit instrument, which in most cases is a HELOC. You can use them, and way beyond the scope of what we're talking about here, the master sweep account is a wonderful tool for getting out of high limit utilization and right sizing your debt load for optimal fundability. Wonderful strategy to do that. You can check out his information, and more importantly, we have a master sweep account podcast at getfundablepodcast.com. We'll include in the show notes, we'll include that link so you can go straight there if you like further research. But now, a master sweep account is also known by some as infinite banking. It simply means that you're becoming your own banker, and you're letting your home equity line of credit become this where you borrow money from to pay other instruments down and invest in other opportunities, just like a bank would do a consolidation loan for us to help us pay down our revolving accounts. Imagine a 22% credit card with a high balance. We want to debt transfer a 5 or 6% home equity line of credit to pay down those revolving accounts. So wherever we can, wherever you have equity, we love the home equity line of credit as that master sweep account. Whew. Wow. All right. Well, that was a lot. We've covered how credit bureaus rank it, how FICO evaluates it, and we've talked about using business strategies or your personal loan, infinite bank for you to build as a family bank. So In closing, I love HELOCs. And wherever I can, I want to help you and each one of you build this bank. And the final thing I'd like to cover is for all of our what some people call the credit invisibles, the unbanked, the people who do not currently own homes. Well, here's what they talk about. Home ownership is like the first and the greatest thing that you can do to build wealth because of the natural increase in appreciation in 99% of our history. Property, even after 2008, they reset, and now most properties are worth more than at the height of that crash. So equity in your home is like free wealth that's being delivered to you. The way to do this free wealth and access it is through home equity. So for all of those first-time home buyers, you're getting out there, ask your mortgage broker about 80-20 loans. That 80% is a first and 20% is a home equity second position home equity line of credit. Now, I do want kind of an advanced strategy for some of you have found it because you're totally passionate about getting out of debt and you want to pay down your mortgage as fast as possible. For our people who don't want to be consumers anymore, they want to become savvy borrowers, but you may not be interested in business borrowing. And even if you are in business borrowing, here is my favorite of all HELOC strategies. Imagine instead of getting a first position loan, like a home loan or first mortgage, imagine getting a first position HELOC. Especially for those of you who've paid off your loans, imagine that let's use the same example. Let's imagine you have a $100,000 valued house and you have no mortgage on it. Imagine getting a HELOC placed on it that may have some closing costs, but that's where the investment comes in. They may have some closing costs you have to pay for, but now let's say they've given you an $80,000 credit line, a home equity line of credit against the value of your paid off house. You don't have any payments to make whatsoever unless you use it. But if you use it, and you use it well, you're able to leverage the value of your home to create more wealth. So whether you're a first-time home buyer looking at it, always ask your mortgage brokers, or you're an experienced home buyer, always ask your loan officer, can I get a home equity line of credit as my first? Now people will say, well, hold it, but what's the difference between a line of credit and the loan? So if your home is paid off and it's worth $100,000 and they gave you $80,000, you now have an $80,000 credit line that when you use it isn't going to make you unfundable by using it like you would if you used an unsecured credit card on your personal profile. Business credit instruments are different. They don't change it done right. They don't change your fundability. But imagine an $80,000 credit instrument you're able to do this with. Now, but let's say you're a first-time home buyer and you want to do a HELOC, but the HELOC is going to be tapped out. It's $100,000, right? So you put in your 20 grand, but you want the first to be a HELOC. So it would be a tapped out 100% home equity line of credit. And then you'd have a little extra above that because most of the lenders want some sort of your skin in the game. So you got to put some money in there. Now they may go to 100%. More likely they're going to go to 80 or 90% of that 100 grand. Now there's no credit limit really to use. But every time you pay down, or anytime you have windfalls of cash and you start paying down this credit line, you're increasing how much available credit and you don't have to go get and you don't have to go get a new loan. If you do this with a installment loan first, like most traditional firsts, then you have to go through the refinance process in order to tap your equity from appreciation or pay down. But if you get a home equity line first, then every time you make a payment, you have more credit line to use, You do your deals, you make payments, and that balance goes down, but that balance is now accessible. Follow me? One of the greatest tools, and I recommend it to anybody who fits the criteria and where it makes sense. I highly recommend it. Now, a home equity line of credit has a couple of downsides. One is that generally speaking, it's a variable rate interest. So if inflation goes up, your payments are going to go up based on the home equity line. So it's not a 30-year fixed. That it could be a downside if you're looking for just the lowest possible cost on your mortgage. Then anytime that you want to access equity, you're going to have to do a refinance of that smaller equity line on top of your first in order to access your money. And even that one will be variable rate interest. So the question is, what can you make, to use our example, what can you make with $50,000 or $80,000? How good of a real estate investor, business owner, business entrepreneur, how good are you at investing that money for a return? Because it might be worth it to have a little higher risk. Talk to your CPA and your tax folks. But it may be worth the higher risk for the cost of this variable rate HELOC for the amount of return you can get on your money. I can't guarantee that you are an amazing investor. I can't promise you anything. But you can look at your track record, and if you are good at the deals that you do, the investing that you do, the choices you make, for passive income investments, whatever your game plan is, your wealth strategy, all of that can be facilitated with a home equity line of credit. Whew, all right. So if you're watching this podcast, go like, review, share, subscribe, join our community so that we can keep going and you can binge all of this high level, awesome stuff. We are recording this live to our Get Fundable Facebook page. So if you're there, please like, love, share, point this out. Anybody who's buying a home, anybody who's refinancing, share this episode with them so that they know what possibilities exist and create the best possible options for them. So give us the loves, give us the likes, and make sure that you can like, comment, share with all your friends and family. This is Merrill Chandler, your host of the Get Fundable podcast and your guide to the fundability universe. Let's do this shit, guys. Let's leverage all the tools and strategies that we have to create wealth for us, our loved ones, and just have an amazing, amazing life.
Thank you for listening to the Get Fundable podcast. Please leave comments because Merrill would love to read about your aha moments from this episode. And be sure to visit getfundable.com to read our blog, get important links, join our community, and much, much more, like ordering Merrill's tell-all book that is changing the world, The New F Word. And you got to tell your friends about this podcast because we want them to get fundable too.